Hello friends, I am Sandip Agarwal. So welcome to my YouTube channel Financial Markets by CA Sandip Agarwal. So this is the video number 2 under Options Advanced, and in totality this is the video number 14 under the Options Learning series. We have already covered 4 videos each under the Options Basic, Options Intermediate Part 1, and Options Intermediate Part 2, and one video under the Options Advanced. So this is the video number 2 under the Options Advanced. After this, we will have another 2 videos under the Options Advanced, and this will conclude the entire learning series on the options. So let's start on this video. So in my earlier videos, I have explained in detail the option Greeks, which is delta, gamma, vega, theta, and rho. I'm not going in detail again on this option Greeks. If somebody wants to revisit this option Greeks concept in detail, they can refer to my previous videos. The link of all those videos I will be putting up in the description section of this video. So just to revisit the delta and gamma of the option Greeks, because this videos basically covers about the delta hedging. Now, in order to understand what is delta hedging and how it is used, we need to go through the option delta and the option gamma basic once again. Now, the delta of an option tells that how much the option price will change when the underlying stock price goes up by 1. Now, it means that if we are buying or selling a call option whose delta is 0.6. Now, the person who has bought a call option, now whenever the underlying instrument goes up by 1 rupee, then the price of that option delta will go up by 0.6. Whereas the person who has sold that call option, so whenever the price of the underlying instrument goes down by 1 rupees, the person who has sold that call option will gain in terms of the decrease in the option price by 0.6 rupees. The delta of the call option is always between 0 to 1, and the delta of the put option is always between 0 to -1. Why? Because whenever the underlying instrument moves in the upward direction, the option price of that call option increases, whereas the option price of the put option goes down, because the call option and the put option have an inverse relationship. In the money, options always have the larger deltas, while out of the money options have the smaller deltas. We can also interpret the absolute value of delta as the probability of the option expiring in the money. Now, if the delta of an option is 0.7, so it means that that option has got the probability of 70% of expiring in the money. Whereas if the delta of an option is 0.3, it means that that option has the probability of expiring in the money of 30% only. Now, what is the option gamma? The gamma of an option tells us that how much the option delta price will change when the underlying stock price goes up by 1 or goes down by 1. So, what is the difference between the option delta and the option gamma? The option delta tells us that how much the option price is going to change in view of the change in the underlying stock price, whereas the option gamma tells us that how much the option delta undergoes changes when the underlying stock price goes up or goes down by 1. Gamma is always positive for the bought options, and it is always negative for the sold options. I have explained in detail about this concept in my previous videos. And whenever the underlying instrument price goes up, the call options delta will always move closer to 1. It will start move from 0 to upward, and it can go maximum up to 1. Whereas whenever the underlying instrument price goes up, the put option delta will start moving from -1 to 0. So it can go up to 0. Gamma is always higher for at the money option, and it falls as the option goes further in the money or out of the money. Now, what is the delta hedging? So I have explained in my basic videos that options can be used for the various purposes. It can be used for the purpose of hedging. It can be used for the purpose of partial hedging and partial generating of income by way of the covered call and cash secured put. And the third, mostly used purposes of the options is the speculation purpose. Now this delta hedging which I'm explaining to you, so this is basically for the speculation purposes or for the purpose of option sale. Now whenever the underlying instrument, which is the Nifty index in our case, moves in the upward direction or in the downward direction, the delta of both the call and the put option will undergo change. It will not remain constant. So whenever a person has entered into a position, whether of a buying or selling a call or the put option, so the delta of that call or put bought or sold option, what would have been there at the time of buying or selling will not remain the same during the entire tenor of that contract, because definitely there will be movement in the index which is the underlying instrument, and accordingly the delta of that bought or sold call and put option will also go under change. Now when I'm explaining the delta hedging, I am assuming that the person has basically sold the call or the put option or a combination of call and put option, and he basically wants to earn money by way of a theta decay and by way of reduction in the IV, which is the implied volatility, which I've explained in my previous videos, that the person who is basically going into the selling of the option, he basically wants to earn money by way of the theta decay and by way of the reduction in the IVs. So now let's assume the person is having a view that the market is not going to move much either upward or downward, or it will move in a very narrow range, say plus minus 1-2%. Now according to his view, what the person does, he basically sells both at the money call and at the money put option. Now as I explained earlier, the delta of at the money a call option is 0.5, which is plus 5 plus 0.5, it's positive, whereas the delta of at the money put option is minus 0.5. Now if we add this delta of both the at the money call and the put option, so the delta is 0. Now this is called the delta hedging. So the person has basically sold both at the money call and at the money put option. Now his delta becomes 0. He is taking a view that the market is not going to move anywhere, or it's going to move in a very narrow range, and he is going to eat up the entire premium which he has received by selling the at the money call and the put option, and that entire premium will become his profit. Now, even though the person has started his portfolio at the time of initiation of this trade, which was the delta neutral, but this will not remain delta neutral always. Now let's say when the person has initiated this position today by selling an at the money call and the at the money put option where the delta becomes 0. Now on next day, say the underlying instrument, which is the Nifty in our case, moves up by 200 points on the upper side. Now since the Nifty has moved up by 200 points, the delta of the sold call option will go greater than 0.5. Now let's assume it goes to 0.6, whereas the delta of the sold ATM put option will become, say, from minus 0.5 to minus 0.4, because since the underlying instrument has moved upward, so the delta of the put option will go downward. It will start moving to 0. Now in this case, after the movement of 300 points in the underlying instrument, which is Nifty in our case, the delta becomes zero point 0.6 minus 0.4 is equal to 0.2. Now, the person who has a sold an ATM call and the ATM put option, which is basically a short straddle, so the person is not having his position as delta neutral. Now he is exposed to a risk of 0.2 delta, which I have explained in this third line, that suppose the market went up, the cause delta will rise say to 0.6 while the put delta will reduce say to minus 0.4. Now, what do you mean by delta hedging? So delta hedging is basically the process of adjusting our trades so that we return to a delta neutral portfolio. Now, how the adjustment will be made in this case? Either we shift the put option to a strike, which is having a delta of minus 0.6. In this case, the delta will again become 0, that is 0.6 minus 0.6, or we move the call option is strike to a strike, which is having a delta of 0.4. So in that case also the portfolio will become delta neutral. Now, this is what called the delta hedging, that the person wants to earn the money by the help of the theta decay and the reduction in the IV, and he doesn't want to take any risk on the delta side. He doesn't want to keep his delta position open. He always want to remain delta neutral. That is, he want his portfolio delta always to be kept zero. So he needs to keep on adjusting his trades in order to return to a delta neutral portfolio. We will understand this with the help of a practical example in the later portion of this slide. I have just explained you in basic that what is delta hedging is all about and where is it used. Now, why the delta hedge? Because the purpose of the delta hedge is to avoid exposure to market direction. So if the person's delta is zero, so whenever the market moves in the upward direction or it moves in the downward direction, the person keeps on adjusting his position in order to keep his delta zero. So in that case, the loss to that person on account of doing a short straddle will always be zero on account of the movement in the market direction, because his delta portfolio is always zero. So basically, delta hedging is basically used when the person wants to trade volatility and he wants to earn income by way of a theta. Now, the more often we are delta hedge, the lower our is directional risk. So a pure volatility trade is one that is held a delta hedge continuously throughout the day, but there is also a shortcome to this, that this is not practically possible. Now, say during the day, the market has given a sharp movement on the upside and the downside 2-3 times in a day. It happens during a certain period of time in the market, though it is not regular, but we have seen that the market moves very volatility on the upside and the downside during the same day. Now, during that time, it may be possible for the person to do the adjustment in order to keep his portfolio always delta neutral. But in case of the overnight, it is not possible. Now, say when the market ends for a particular day at 3:30 p.m. Now, before that, the person has basically hedged his portfolio and he has basically made the his option selling portfolio to a delta neutral hedge. So the delta of the open position is zero. Now, say when the market opens tomorrow, the market opens gap down or gap up by 500 points. So in that case, obviously the delta of his portfolio will not be zero. Obviously, it will move in the upward direction or it will move in a downward direction and it will not be zero. Why? Because the market has opened already gap down or gap up by 500 points. So even though the person can adjust the position after opening the market, but it is not always possible to adjust his option selling portfolio to a delta hedge. So there will always be a bit amount of market direction risk will be open in terms of the open delta position. Now the purpose of delta hedging is always to reduce risk. So even though the delta hedging on its own doesn't decrease the returns of the person, but the delta hedging incurs the transaction cost and it reduces the returns. Because initially when the person has sold an ATM call and the ATM put option, so he has basically initiated two trades. Now whenever the market moves in the upward direction, the person will start adjusting his either the uh, put option sold side or he will start adjusting the call option sold side. So whenever he will buy and sell another leg of the option or strike price, so obviously there will be certain brokerages and the cost associated with it. The more and more the person adjusts in a particular portfolio, the more and more the brokerages and the other taxes will be levied. So the delta hedging is also a costly affair as well, and it will decrease the return over a period of time. And the more and more we try to do the delta hedge, the transaction costs are higher. But in case somebody wants to avoid the market direction risk, then it is always feasible for the person to do the delta hedging. And it is not always possible to keep the delta always zero. Like say at the time of initiation of the trade, the delta is zero. Now, after a certain period of time, when the market moves in the upward direction or in the downward direction, now say the delta of that portfolio becomes say 0.1 or minus 0.1. So at that level, it is not recommended to adjust. It depends on person to person up to what delta the person is comfortable in and he doesn't want to adjust, and beyond what level the person wants to adjust and he want to reduce his delta risk. Because there are certain point of time in the market when the market is too volatile, it gives movement 200 points on the upside, then again it gives 200 points movement on the downside. So every time when there is a movement, the person, if they keep on adjusting his portfolio in order to bring the portfolio to the delta neutral position, so he will incur lot of cost and it will also involve lot of time. So that's why it depends on person to person up to what delta level the person is comfortable in and he doesn't want to do the hedge, and at what level the person wants to do the adjustment in order to reduce his delta risk. Now, I have just taken a screenshot from a website called as Options iCharts. So I will show you how we can use the delta hedging. Let me just zoom it. Now see, on this side, you can see the various strike price are mentioned. So all this strike price are of the Nifty underlying instrument. So it starts from 17,000 strike price and it increases at the interval of every 50 points. So you can see I have taken the delta of the Nifty options starting from 17,000 strike price till 17,900. Let me just zoom it again. I think it has not come. This is fine. So you can see on the left hand side, the delta which is mentioned, this is of all the call option strike price of the Nifty options. And on the right hand side, the delta which is there, it is all of the put options. So now let's say for an example, the person wants to do the short strangle. So if we recollect what is short strangle, so short strangle was basically of selling an OTM put option and at the same time selling an OTM call option as well. Now when I have taken this screenshot, the Nifty was trading somewhere around 17,500. Now say somebody chooses to sell a put option of 17,100 strike price. Now we can see the delta of 17,100 strike price is around minus 0.25. Now, if somebody wants to have a delta neutral portfolio, he should select a strike price on the call option side, which is having a delta of around 0.25 only. Now we can see that the strike price of 17,850 call option has got the delta of plus 0.264. Now, in case somebody wants to do a short strangle, then it is recommended that the person can sell a put option of 17,100 strike price and at the same time he can sell a call option of 17,850 strike price. The delta of this portfolio will be zero. He can simultaneously select another strike price of put option and the call option depending on his risk appetite in order to keep his delta position as neutral. Now, so the screenshot which I have taken on this screen, I have taken when the Nifty was trading at around 17,500. So you can see the delta of 17,500 call option is around 0.49 positive. and the delta of the put option strike price of 7,500 is around minus 0.51. So if somebody wants to do a short straddle, they can sell ATM call and the ATM put option of 7,500 strike price, whose delta will be almost neutral. It will be almost zero. And whenever the market moves by a certain points, depending on the risk appetite of the person, in order to keep his market position open, he can accordingly hedge. So I hope you have liked this video and you are finding the contents of this video as useful. In case you are liking my video, please do like and subscribe to my channel so that you can get notification for any future videos which will be uploaded in future. And in case if you have any query on this video, you are free to give your feedback and comments in the comment box, and I will try to address all those queries in my future videos. Also, in case you feel that my videos are adding value to you, so please do share my videos and the YouTube link with your friends and families. Thank